S-Corp elections aren't magic. In this video today, I'm going to go over how S-Corp either will harm or hurt your business and when to do it. Hi, my name is Zachary Jensen. I'm the managing partner here at TaxWise, where we're helping small business owners and high-income professionals reduce their tax liability and grow their wealth faster. In today's video, we're going to go over the basics of S-Corp and why people care about it. S-Corp election is one of these things that a lot of people look into when they start making real money, and they can accidentally overpay thousands of dollars in self-employment tax every year without realizing it. So if you're currently a sole proprietor or LLC considering this, the IRS generally treats all of your profits as earned income, meaning you're going to get hit with, on top of your regular tax bracket, an additional 15.3% for Social Security and Medicare tax. So if your business makes $150,000 in profit, you're not just paying income tax, you're also paying a massive payroll style tax on top of it. And the S-Corp matters because it's one of those few clean strategies where you can legally reduce that extra tax once you hit the right income level. So what an S-Corp election actually does is it changes how your business income is classified. Instead of the IRS treating all of your profit as self-employment income, an S-Corp election forces you to pay yourself what's called a reasonable salary through payroll. And then you take the remaining profits as distributions. Now, your salary is still subject to payroll tax, but the distributions themselves are not subject to self-employment tax. So here's a simple example. Let's say you imagine your business earns $200,000 a year in profit. Okay. If you stay as sole proprietor, you might pay yourself employment tax on most of that. But if you elect the S-Corp election status and pay yourself a $90,000 salary, let's say, that remaining $110,000 comes out as distributions, which avoids that 15.3% self-employment tax for the Social Security and Medicare. That difference alone easily saves you $10,000 plus per year, depending on the numbers. Another example, let's say your business is profiting $180,000. If you're a sole proprietor, you might owe roughly $25,000 in self-employment tax. This is depending on the exact cap and Medicare portion. But if you switch to S-Corp, you pay yourself a $90,000 salary, and then you pay payroll taxes on that $90,000, but the remaining $90,000 is not hit with self-employment tax. That could reduce your payroll-related tax around another $13,000 to $15,000-ish. And even after paying for payroll software, any bookkeeping or tax prep costs, the business owner still nets, over $10,000. So that's why S-Corp is still such a very powerful, no-nonsense strategy for the right type of business owner. The process to do an S-Corp election is very easy. You don't actually need to form a new company or anything like that. You just file the form 2553. So this allows you to elect S-Corp treatment. Usually your existing LLC or corporation, once approved, you can start running payroll yourself, issue a W-2 using a product like Gusto or ADP or one of these, and then treat your owner withdrawals as distributions. You can just move that money directly to your bank account. That's it. Super simple. And it counts as a distribution. Most business owners think, it's overly complicated, but honestly, it's routine work, and a competent tax firm can do it for you pretty easily. So your accountant can typically do the election, help you set up payroll, make sure you got a good bookkeeping system in place to make sure you're tracking salary versus distributions. And if you have an organized accounting team, it takes a couple hours to do. It's not a big deal. Really, the key here is knowing when not to do it. So if you're a business owner that's only making, 40 to even 80,000 in profit, usually the S corporation doesn't make mathematical sense because the payroll and tax filing costs can eat up most of that benefit. So usually it doesn't make a ton of sense if your income's inconsistent, right? So if you have one good year and then another year with less income, you might not want to do it. So people ask, very often, how much should my salary be, right? Can I still deduct all my expenses? Can I do this retroactively? In general, the best time to consider S corp is when your profits are consistently above that roughly $80,000 to $100,000 a year. And then at that point, you won't be no longer asking, is it worth it? It's usually how much money am I extra leaving on the table? So hope you liked this video. Hopefully we can help you answer the questions I mentioned for your business. And if you have additional questions, reach out to us. Our contact information is in the description below. Thanks so much for watching, and have a great day.